subscribe.
Welcome back to Switzer. Whilst 2015 has been a tough year for investors, a number of professional managers are revelling in this volatile and changing environment. It's fair to say that 2015 has been the year of the stock picker. Our next guest is a fund manager who is here to tell us how he's investing and what he'll be watching in 2016. Stuart Jackson, welcome to the show.
Thanks, Marty.
So, tough year last year, the year that almost was, 2015 for investors. The Fed, China, number of issues that we've spoken about many times. What's your view on the market at the moment?
Yeah, in terms of the market, obviously it has been a tough market. We've seen, if you look at the All Ords accumulation index over the last 12 months, it's up a bit over 2%.
Yep.
But if you maintain a very disciplined approach to what you're looking to the stock analysis and to picking stocks, focusing on companies that have strong prospects, that have the ability to reinvest in their business for growth at good rates of return, you can still do very well, and that's demonstrated by the performance of our funds over the same period. We've delivered over 16% returns after fees, and that's with 20% cash in the portfolio as well. So primed for new opportunities. So we continue to scour the marketplace for the real good opportunities, the companies with very good franchises that have a growth opportunity in the marketplace.
Talk us through some of those companies.
Yeah, look, so one of the things we've spent a lot of time focusing on is the ageing population, for instance, and the demographic shift that actually occurs with that. And a lot of obviously investors are aware of the growth in superannuation funds, and that's been a big part of what we've invested in for a while. So if you look at companies like Magellan, like Henderson Global, they're exposed to an asset allocation shift, which augments that growth that's naturally coming from the superannuation pool through a shift in asset allocation towards global funds, and something that's more difficult for the individual to actually replicate.
So when you invest in, say, a Magellan or a Henderson, you're saying that you're investing in it's a proxy for superannuation, or it's a proxy for the market in general? Well,
it's a bit of both in a sense. Yeah. What you've actually got here is a pool of demand which is going to grow because of demographic shift over a period of time.
So it's mainly super, yeah?
So, the market itself will grow. And then you look at, so there's the overall market growth, there's the ability to actually grow with that, what that actually does to the earnings of the business, to the return on capital, how much marginal capital has to be reinvested to actually tap that growth, and what then is deliverable to the actual investor himself. So, the companies like fund managers can actually deliver strong top-line growth, leveraging a fixed cost base. Yeah. Over time, the scale benefits accrue, minimal capital requirements, unlike, say, a bank who has all the prudential requirements.
Now?
It's top 100, certainly. They've performed extremely well, both those companies. I think the other area we're sort of looking at is the next phase of that, as the baby boomers transition from an asset accumulation sort of phase through superannuation to one of retirement and income generation. And so that's where a company like Challenger fits in. More capital intensive, but there is a strong demand for income producing assets over a long period of time, and that
recurring revenue.
As well. So
superannuation is obviously a theme that you guys are playing. Yes. What are some other themes you're playing and the stocks off the back of that?
Well, disruption obviously is a term that a lot of people use.
Popular word. Now, I think that was the year of 2015, wasn't it?
For disruption?
Yeah.
Oh, yeah. I mean, there's a lot of talk about it.
Hopefully it's a new word in 2016.
One of those stocks that we think is a key player in that marketplace is REA Group.
Okay.
And a lot of people discussed how the fact that clearance rates have started to come off with the property market cooling a little bit, and you can see the bank aggregates as well, that investment demand is coming off a little bit through APRA's measures that they're trying to implement. In terms of the implications of that for REA Group, the balance of power sort of shifts back to a buyer's market. The sellers actually need more tools to actually try and sell their property. And someone like REA gives them reach and gives them into the buyers fairly effectively and fairly efficiently. So
obviously the primary advertising stream is still, the primary revenue stream in REA is still advertising?
Yes.
Yep. Yes. Any other new additions to the revenue mix that
over
are interesting?
Time, invariably there will be. Yeah. And they'll continue to value add to the real estate agent industry. Through automation and some of the data analytics they can actually bring to the marketplace, similar to what Seek's doing, for instance, in the employment market. But at the moment, what you're actually seeing is an upsell sort of strategy coming through in terms of premium sales. And
you formed a view on McGrath and how they're going to perform with the IPO coming up soon?
I don't want to. Look, we're not going to participate in that one, but from our perspective, it's difficult to. They're a bit more exposed, I suppose, to the actual market movements themselves, having the revenue linked to property prices themselves. And the whole incentivisation around human labour and the value of that labour and the ability to actually retain that human capital is a concern that we have. But there are some big investors that are actually looking quite seriously at that from what we gather, and quite like it.
Yeah, well, I guess there's a strong management team that plan to stick around, which I think is always a positive for a company like that. But moving on, some other sectors or themes that you're playing?
Yeah, look, another one is, again, it's around technology to some extent.
Yep.
It's about scale, and it's about a structural shift in their cost base and leveraging their scale, and that's Medibank Private.
Okay.
So it's one that the market has a bit of trouble with occasionally, that, in terms of PE multiples, but you've got to remember that there's a lot of that earnings is generated by cash and fixed interest, which at the moment earns a very low rate of return, but doesn't mean it's worth less than the face value of that cash. But so from a risk perspective, it sort of balances out a lot of the other risks in the operational side. But if you look at the opportunity through technology, through the new systems that are coming through to actually improve their business over time, and to really leverage the scale position they've got, their efficiency ratios, so their management expense ratios and their claims ratios can improve quite dramatically over time, with some of the benefits going back to the consumer, some of them going to the shareholder, and they can create a real competitive advantage in that. Now, there's a lot of uncertainty in the stock for the next sort of 9 months associated with various regulatory reviews. Some of those things will be negative for the industry, some will be positive, but ultimately it's an industry that is vitally important to the whole of Australia, whether it be political or just the consumer itself. So the industry's got to be viable, and within that, we believe that Medibank can actually improve its positioning and its competitiveness over a period of a number of years.
Any of the beaten up blue chips on the radar at the moment?
Well, look, in terms of that, again, it comes down to what we believe to be good quality businesses. What companies can actually reinvest back into their business at good rates of return on a long-term basis. Yeah, big companies have a tendency, obviously, just law of large numbers. It becomes a little bit more difficult. But when you're talking about big companies, you're talking about resources. Traditionally, it's not an area we've played in. It's more difficult to get a sustainable return on capital. Look, Woolies, the problem from our perspective is we think they've got a fairly elongated period of reinvestment. And that means margins probably come down for a sustained period of time before they convince the consumer that things have improved. Service levels have got to pick up, gross margins got to be handed back, to some extent become price competitive. But it takes a long time for the consumer to recognise that that price positioning has actually changed. And with Aldi continuing to expand, it becomes a more and more difficult task for a company like Woolies. And one of the things they've got to work out is, do they want to be a supermarket for everybody, or are they going to sort of have a core consumer? And the problem is that people who want to be something to everybody, you look around the world, it's become increasingly difficult. You tend to get taken advantage of, cherry picked by more nimble and focused companies.
Stuart Jackson, thanks for your time.
Thank you.
That's the show. If you want to read my thoughts at the close of Wall Street, check out our website, switzer.com.au. If you want to get our thoughts on super, visit the switzersuperreport.com.au for a free 21-day trial. And if you've got any questions for me or ones you'd like me to put to an expert, email me, switzer@switzer.com.au. You can also catch me on Twitter. The handle is @Marty Switzer. I'm Marty Switzer. Have a great weekend.